All right, let's get right into it. Today, we're diving deep into a really specific and honestly, a super important corner of retirement reporting. We're talking about distribution code H on Form 1099-R, specifically for direct rollovers from a designated Roth account to a Roth IRA. Now, getting this one little code wrong, it can cause some major headaches. So let's break it all down. So let me just ask you straight up. Are you 100% certain that your process for this is correct? Because this is one of those areas where almost right is completely wrong. The difference between these codes isn't just a suggestion, it's a legal requirement with some pretty serious consequences. And listen, the stakes here, they're incredibly high. You use the wrong code, and boom, you could trigger automated notices from the IRS, lead to your participants getting hit with bogus tax bills, and maybe even put the special tax status of their retirement money at risk. It's just a tiny box on a form, but it has massive implications. Okay, so here's our game plan to get this right. We're going to start with the why, the legal foundation for all of this. Then we'll dissect the codes that cause all the confusion. We'll walk through the form, box by box, then trace how the data flows from start to finish. We'll even cover some special cases, and finally talk about what happens when things go wrong. First things first, to really get how to do this, you've absolutely got to understand why we do it this way. The whole reason Code H even exists is because of a really fundamental legal idea in the Internal Revenue Code. And that idea is called the separate contract rule. You can find it in IRC Section 402A.D.4. And what it says, essentially, is that a designated Roth account, like a Roth 401k, has to be treated like its own separate thing, completely distinct from any pre-tax money in the same plan. That means the plan administrator has to keep a super careful record of the basis, the contributions, and the earnings separately. So here's the crucial part. That separate accounting, that distinction between basis and earnings, it has to stay intact when the money moves. Think of Code H as a big, bright flare you're sending up to the IRS. It's a signal on the 1099-R that says, hey, pay attention. A separate contract with its own unique tax DNA is moving from a plan over to a Roth IRA. It's all about preservation. And that brings us to the number one tripwire for filers, mixing up Code H with its neighbors, Code G and Code B. Let's make this distinction absolutely crystal clear. Just look at this side by side. Code G is kind of your general purpose tool. It's used for a bunch of different rollovers. But Code H, it's a specialist. It is used and it is mandatory for one specific move and one move only, a direct rollover from a designated Roth account to a Roth IRA. For Code H, both the source and the destination are completely non-negotiable. And hey, don't just take my word for it. The IRS spells this out in black and white. Right there in the instructions for the 1099-R, it says, and I quote, "Do not use Code G, use Code H." They put that negative instruction in there for a reason, because they know it's a super common and very significant mistake. Now let's also put Code H up against Code B. Think of it like this. Code H is for a direct rollover, where the money moves like a secure bank wire from one financial institution to another. Code B is used when you hand the money directly to the participant, who then has 60 days to roll it over themselves. As you can imagine, the Code H process is so much cleaner. It confirms the rollover happened, and it helps the taxpayer avoid a bunch of complicated tax rolls. Okay, theory's done. Let's get practical. Let's pull up the form itself and see how all this stuff translates into actually putting numbers in boxes. This is where that separate contract rule really comes to life. So for a Code H transaction, you've got 4 key boxes that have to work together in perfect harmony. Box 1, that's the total amount being moved. Box 5 is where you put the basis, that critical number from the separate contract. Box 7, of course, gets our star of the show, Code H. And maybe most importantly, Box 2A, the taxable amount, has to be 0. Now, I really want to double-click on Box 2A, because this is a huge deal. A Code H is telling the IRS that this is a non-taxable transfer. So, if Box 2A shows any number other than 0, you're basically sending the IRS a contradictory message. It's an immediate red flag. The instructions are very clear. For this transaction, Box 2A must be 0, period. Okay, let's pull the camera back a bit. It's super important to remember that this Form 1099-R you're issuing, it doesn't just disappear into a black hole. It's actually the very first domino in a chain of data matching that goes all the way to the participant's personal tax return. So here's how the story unfolds. First, you, the plan administrator, issue the 1099-R with Code H. Next,
The Roth IRA custodian that receives the money issues their own form, a Form 5498, showing they got a rollover. Finally, the taxpayer takes both of those forms to correctly report the whole thing as non-taxable on their 1040 and to update their total Roth IRA basis on Form 8606.
And this table really shows how everyone has a specific job. The plan administrator reports the source, the IRA custodian reports the destination, and the taxpayer puts it all together. You can see how a mismatch, say a code H on the 1099-R, but the 5498 says it was a conversion, well, that's going to get flagged by the IRS computers almost instantly and spit out a notice.
All right, we've covered the standard playbook. Now, let's talk about some of the curveballs you might see, including a few edge cases and, of course, how to fix things if you make a mistake. Here's a really important one to file away: the non-spouse beneficiary rollover. They're allowed to roll over assets, but it has to be a direct trustee-to-trustee transfer. So the reporting for this is a special combo. You use Code 4 for death plus our Code H. That combination tells the IRS exactly what's happening: a valid direct rollover into an inherited Roth IRA. So what happens if you mess up? Look, it happens. The key is to fix it and fix it fast. The rules say you have to file a corrected Form 1099-R. So if you accidentally used Code G for that Roth 401k to Roth IRA rollover, you've got to issue a corrected form to change it to H. And it goes the other way too. If you used H for a plan-to-plan Roth rollover, that's wrong. It has to be corrected to G. Okay, last section. And I want to shift our thinking here a little bit. Getting this stuff right isn't just about ticking boxes to keep the IRS happy. It's a fundamental part of your legal responsibilities as a plan administrator. Let's talk about this number, 20%. That's the accuracy-related penalty under Internal Revenue Code Section 6662. This penalty can get tacked on to tax underpayments that happen because of reporting errors, things like negligence or just disregarding the rules. This is the real financial bite that can come from getting these forms wrong. And it can go even deeper than IRS penalties. We have to talk about your fiduciary duty. As a plan administrator, you have a legal obligation to act in the best interest of the participants. Providing accurate tax reporting is part of that duty of care. If there's a pattern of failure, of constantly using the wrong clothes and causing financial harm to people, that could be seen as a breach of that sacred duty. So really, it all boils down to this one critical truth from our source material. This is not an area where you can be creative or just make your best guess. Strict, by-the-book adherence to these technical standards is your only real defense. It protects the plan, it protects you, and most importantly, it protects the participants' retirement savings. So I'll just leave you with this question to think about. When it comes to reporting these very specific, high-stakes transactions, have you built a process that's based on that strict adherence? Take a hard look at your own process. Is it truly a rock-solid defense? Thanks for joining me.